Back with markets at lunch, still reeling under pressure. More importantly, Europe as well has kick-started on a rather bleak note. So across the board, you're seeing almost a 1% cut coming in. Mayuresh Joshi from Angel Broking joins in to talk about his thoughts on the markets. Mayuresh, hi, afternoon. What explains this weakness across the globe? And would you say the failure of Trump to actually put through the healthcare bill may be the key trigger?
Afternoon, Aisha, that might be one of the probable reasons that you're seeing a sell-off. The markets did move up significantly, whether that be India or the global markets, including the US markets. So I think the markets are taking a breather because valuations obviously on the higher side, and specifically in the Indian context, I think we'll be reacting to two sets of news. A, I think the valuations probably have gone over the roof at this point of time, looking at how earnings are panning out. Yes, I think the government formation and the kind of reform processes that the government is doing it exemplarily, but I think the markets will want to re-rate themselves only when earnings come through, which do not seem likely, at least for the next 2 quarters. Secondly, I think what happens from the global scenario, I think specifically as you rightly pointed out, I think if Trump is able to not put forth his scheme of things, including the healthcare bill that probably did not go through and the taxation policies, you might see sell-off happening because the markets there as well have peaked off in terms of valuation parameters as well. So largely I think it's a general sell-off that you're probably seeing in the market because of valuation concerns, and again policies probably not going through for the US markets. But in my opinion, again, it's going to be a stock-specific approach, specifically for the Indian context.
So what is your sense, Mayuresh? Because today you're seeing more globally linked sectors like metals, for instance. They are the ones which are really cracking hard in trade. Is this the time to really go short in the near term on the metals pack? And do you sense that it's more the globally linked sectors which are going to fall harder in this current correction?
So obviously, I think when volatility probably stays on a higher scale, you're probably going to see global linked sectors, whether they are commodity linked or asset-backed linked. When you're talking about asset-backed, whether it's autos, auto ancillaries, that probably can get affected in terms of a imminent slowdown that can come through, and again the currency risks that probably can pose as headwinds. So my own take is that in a scenario like this, I think it's better to focus on domestical cyclical stories where the growth prospects can probably look much better over the next 4 to 8 quarters. Having said that, probably I think the kind of government capex program that is happening in key sectors like infrastructure, roads, highways, power, ports, I think there are plenty of opportunities that one can probably look at within these sectors as government orders start flowing through, as margin improvement starts happening for a lot of companies associated with this sector, and as working capital constraints start to ease. My own sense is that the cash flow improvement can be evident. Few sectors can be construed where overcapacity is probably still there and utilization levels still probably remain low. But again, I think as the economy starts picking up steam over the next few quarters, as private capex picks up over the next 3 to 4 quarters, my own sense is that earnings should start showing respite by the second half of this fiscal in a more meaningful manner, and that will lead to probably credit growth picking up, which is essential for the banking and financial system as a whole, and that will probably give leeway to what kind of earnings outlook one can define for the next 2 years. So largely again, I think domestic consumption and cyclical stories is something that I remain very, very optimistic about.
Hi Mayuresh, this is Nantara from New Delhi. At the start of this interview, you spoke about how valuations have gone through the roof. At the same time, you're believing in a domestic consumption-led story. You've talked about infrastructure and government increasing its orders. But what about the consumption-led stocks and sectors? Which are the ones that you think are the better ones, whether it's auto, real estate, FMCG? Which are the ones that you think are doing better than the others, the one that people should bet on?
Afternoon, Nantara. I think individually, if you look at consumption, and you can define the basket to be pretty large. So auto ancillaries do form a part of this basket. Obviously, FMCG consumer staples form the integral core of the internal domestic consumption story. But again, I think internally everything is probably linked in terms of consumption related to how cement will play out, how steel will play out, how the road sector will play out, how the power sector will play out. Because I think that's where the government focus is. It's another 2.5 years till the general elections, and the government is pretty focused focused in terms of providing the right infrastructure to the length and breadth of the country. Having said that, my own sense is that autos, for example, have seen a dismal performance in terms of volumes over the past 2 to 3 years. As the activity starts picking up and as the entire theme of demonetization, remonetization waves off over the market, because one really does not expect earnings to meaningfully pick up in Q4. My own sense is that with a good winter output coming through in terms of a good Rabi harvest and realizations improving there of expectations of good monsoon expected with the first initial reports, I think the discretionary spending will go up and that will probably lead to more demand in terms of volume growth picking up. So selectively four-wheelers like Maruti is something that I've always liked. From the rural focus themes, I think Hero MotoCorp is something that I remain extremely optimistic about because the entire focus again will work on how rural consumption will play out, and I'm very, very optimistic that it will drive volume growth for stocks like Hero MotoCorp. Similarly, auto ancillary companies like Amara Raja, they have largely underperformed the market leader X side, but looking at the way the market is positioning, GST coming through, the paradigm shift happening from unorganized to organized, I think all these stocks will benefit. So I think cement, JK Lakshmi Cement is something that we've been liking for a long time. I think this should benefit within the infrastructure space itself. I think L&T has largely underperformed within the large cap names. As more orders start coming through the next 3 to 4 quarters and as the recognition and execution specifically of the domestic E&C starts improving, I think this is one stock that can really be held on by investors. Banking and financial services, I think the credit growth has languished very, very meaningfully over the last 2 years, 4 to 5% over the past few quarters. But as that starts picking up, as end user constraints start coming down, I think the banking and financial space, whether you define that to be the large private sector banks, large public sector ones, or selectively NBFCs, which include housing finance companies or rural focused equipment finance companies, stroke tractor finance companies, I think these are stocks and sectors that can really be looked at in Nayantara from a 12 to 18 month perspective.
Mayuresh, you talked about Hero MotoCorp. You also spoke and you said you're betting on auto and auto ancillaries. You told us your top pick for two-wheelers. What about the four-wheelers that you also talked about? Which is the top stock you're looking at in that segment?
So largely again, I think Maruti has done exceptionally well over the past few quarters. The new launches, the kind of platforms that it has introduced, I think very well accepted by the market, and that is clearly being seen in terms of the demand, the kind of waiting time periods that you've got for models like a Brezza, for Baleno, I think is still pretty huge. Secondly, I think the Gujarat plant comes on stream, so you've got another 250,000 odd units coming through on that front. So I think it's going to be a good utilization in terms of new models and products coming through, which are very well accepted into the markets. Thirdly, again, I think even if you see the volume growth that has happened for Maruti over the past 2 years and the expectations laid off over the next 2 years, I think very well envisaged that volume growth can pick up meaningfully for Maruti, and with the cash-rich balance sheet which is getting deployed, the indirect share of imports having come down, which reduces the reliance on the kind of yen impact that had on earnings, I think that gets down drastically, and that probably improves the EPS for the company over the next 2 years. So I think Maruti on declines is something that will be tempted to look at. I think there is still a long way to go for Maruti in terms of both an earnings trajectory as well as the return ratios actually picking up meaningfully even from the current levels.
Okay, Mayuresh, great speaking with you. Thanks much for joining in with your take on the markets and various stocks and sectors.
Thank you so much.
That's the word coming in from Mayuresh Joshi from Angel Broking. Let's take a very quick break. Haven't done that in a while. And as we do that, here's a word coming in, or rather, let's talk about a stock which is now at a record high. Several marquee investors like Rakesh Jhunjhunwala as well have logged into it in the recent years. Edelweiss is celebrating their 21 years of being in business, and on this occasion, my colleague Ajay Sharma caught up with the